Hey, thank you for joining us, all you out there in the Let's Talk Money. Joseph Hogue here. Love doing these live streams every Sunday. Welcome to another Beer Money Sunday. I've actually got an 86 Gold Dutch beer, part of a gift basket for Father's Day. So you know what my family gets me for whenever they need to buy me something. But happy to see you. Glad to see you from wherever you're at in the nation. There, I see a lot of people, a lot of Bowtie members out there. Net Ghost from Corpus Christi, or no, Net Ghost from Vietnam, an undisclosed beach in Vietnam with 25 cents a bottle local lager. That's pretty good stuff right there. Danny from Corpus Christi, shot by Lucasfilms. Thanks for joining us. Love doing these again. These beer money Sundays, just kind of a chance to relax, take off the tie, and talk to you about money. And great topic this week. Happy 4th of July, happy Independence Day for all you out there in the nation from the United States, wherever you're at in the world. Though, happy Sunday. And everybody talking about independence, and got me thinking about the other kind of independence, right? Because even in nations where we feel like we're free, or legally we're free, we still feel like slaves, right? You feel like a slave to the paycheck, or feel like a slave to time. There's just not enough time in the day to do things because you have all these other commitments that you have to do because you need that financial independence. So I really wanted to talk about this idea. All you out there in the nation, this is one of my favorite topics that we really just don't get to that much on the channel. We talk mostly about stocks and investing, but there's so much more to financial independence than just those investments. So I want to cover kind of those three ways to financial independence: investing, passive income, and kind of starting your own business. Trying to break free from that dependence on someone else's business and that kind of thing. So let's get started here. Before we do start, I want to invite everybody to the Bowtie Daily. It's our free market update newsletter. It goes out every night before the market is open, and it's just a great resource for market trends, news, all the strategies that we're covering here in the Bowtie Nation. Again, that's absolutely free. Something I like to do for all you out there in the community. Goes out each night at 9 o'clock Eastern time before the market opens. So that means it won't go out tonight because the markets aren't open tomorrow. But we'll have another issue going out, tomorrow night. Get your set up and ready to invest. But let's get to it because, like I said, I'm really excited to be covering this idea of financial independence and how you can really, get there without necessarily just investing in stocks. And first, I think you really need to know what's financial independence for you, because it's got a different definition for a lot of people. A lot of people out there, financial independence is basically just having enough money that you never have to work again, right? And I mean, this was my outlook. This was my definition for the better part of my 20s, right? I started in corporate finance, moved quickly to investments and an analyst position. And even though I liked the job, liked what I was doing, I didn't like the job. I hated the job. I hated going into work and having that structure and not feeling like I was in control of my financial future. So I spent half the day just kind of daydreaming, zoning out, and thinking about, I don't know, some white beach, sandy beaches, and Mai Tai cocktails far away where I didn't have to work and do anything. And eventually I got to a point where it dawned on me that, well, okay, you know what, even if I can retire at 35, 40 years old, what the hell am I going to do for the rest of my life? You've got the better part of 40 or 50 years sitting there, and my ties get a little old, right? So I kind of came to a little bit different definition. It's really just not having to worry about that a bill or that emergency expense. So with that definition, you might actually still be working. You might actually still be working for someone else even, but you don't, you're not worried about those bills or that emergency expenses. You built yourself, a portfolio or a nest egg or whatever that provides that income that's beyond, your job or really, supports you otherwise. It's also just not having to worry about working that job, right? For this was the biggest thing was, having that freedom to do whatever I wanted, make money at it, and no matter how much that it makes to start off with. I started my blogs, my internet business in 2000 and late 2013, 2014. Really didn't even start making money until early 2015, right? So it was about 6 months before I made any money on it. Within about a year, it was only about $2,000 a month. Of course, now it's about $55,000 a month through the YouTube channel, through the blogs, other courses and products and things like that. But it didn't start off like that, right? And that's financial independence, where you can get to a point where you can explore those kinds of things, those kinds of your own business or passive income or things like that, and not have to worry about making money right off the bat, not have to worry about that. So I want to work through some of these 3 ways of reaching that financial independence, kind of some ideas, show you why you probably shouldn't be just focusing on just one. And we all love to talk about stocks here on the channel, but if you look at the chart here, it'll really kind of open your eyes to why maybe you need some of these other ways of reaching that financial independence, making money, some of that passive income, or your own business. And here, you see you got 4 lines here, and this is a return on $500 a month, right? So if you invest $500 a month at any of these 4 returns, how long it takes you to reach $1 million, right? Which isn't necessarily the definition of financial independence. It depends on where you're at, how much cost of living is, things like that. But it's a good benchmark that we can go from. And really, this chart shows you that, okay, so the far right line, 10% return. If you're able to make 10% return every single year, invest $500 a month, it's still going to take you 30 years, 3 decades to reach $1 million portfolio, right? So that's basically working your whole life until retirement, okay? Give or take 5 or 10 years or so there. And that's really what we're looking at with stocks, okay? I think the recent stock market, even over the past 10 years, has really spoiled investors. We've gotten about a 12% annualized return over the past 10 years, been a little bit higher even over the last couple of years, upwards of 12 to 14%. And that is just not normal, okay? Over decades out, you go back out as far as 3, 4, 5 decades, and the average annualized return on stocks, the broader stock market, is actually closer to about 7 or 8%. Okay, so 10% is actually kind of stretching it even. But even if we're assuming that we can get 10%, that's still going to take 30 years to reach that $1 million portfolio. But if you start exploring these other ways to boost that return every year, and I'm not talking about boosting it through riskier investments. Okay, yeah, sure, you can invest in the smallest stocks, the small stocks, the penny stocks. You can invest in some of the high growth trending stocks, things like that. The next hot investment, basically, maybe get an extra 10%, so maybe 20% a year on your money. But even if you see here this red line, that's 20%, and that's still going to take you almost 20 years. Okay, and that's if you can get that 20% every single year and not lose half of your money during the next stock market crash, because that's really the reality of a lot of these higher risk investments, right? We talk a lot about these penny stocks, crypto, and other those other investments on the channel, but the reality is higher risk, higher return equals higher risk, and you are going to see those bigger drops in your portfolio. So what you really want to focus on, if you're really trying to reach that financial independence, and especially if you're trying to reach it faster, you really need to go for those higher return ideas, which are going to be things like these things that we're going to talk about with passive income, with your own business, things like that. And again, it's not necessarily an only one idea here. You can invest in stocks. I still invest in stocks as well, even though I own my own business. I do some of these passive income things that we'll talk about. But you can't rely on it exclusively to get to your financial independence, because again, if you want to be financially independent when you're 70, okay, I guess after 30 or 40 years of saving and investing, then enjoy those white sandy beaches with your little rocker there, with your little walker, with the little tennis balls on it. Those don't do too well in the sand. So maybe if you want to get to those white sandy beaches a little bit sooner, then you need to be doing something other than just stocks. Okay. Because yeah, I mean, if you can do 30% return a year, and that is extremely possible. Like I said, I started the blogs in 2013, 2014, started making money in 2015, and so what do we got? 6 years now, and I'm up from basically zero, from a few $100s a month up to 55,000 a month on income, and so that's 6 years. Within 2 or 3 years, I'd say it was up to a few $1,000s. So definitely paying the bills a month. And you get to that level of income and you start investing more. And so basically, maybe you're not getting that much more return on your stocks, but you're investing so much more that it's the same difference, right? So what I want to do is kind of walk through some of these different ideas for passive income, your own business. We'll of course have a Q&A at the end of the session, and actually I've got a couple of links to videos in the video description. Now, I mean, obviously, in a quick live chat, I want to get you back to your barbecues and hamburgers and stuff like that. So a quick live chat, we're not going to be able to cover the details into how to start an online course, how to start an affiliate blog, or some of these other business ideas. But I've got a lot of detail in the videos there in the description. So I just want to kind of get the basic ideas here for you in these different income sources, and then do the so it gets you from that 10% market return maybe to 15% or even 20% over shorter periods. But again, if you're going to want to go for those higher returns, you've got to look at these other income sources, right? So with passive income here, I'm not talking about stocks or dividend stocks. They have a passive component, and if you search for passive income on YouTube, there you're going to find all kinds of videos about passive income dividend stocks. For me, it really doesn't seem like passive income. That's more investing. Okay, if you're talking about dividend stocks, if you're talking about stocks as passive income, that's investing, right? Passive income should be something totally different. So we're talking about true passive income investments, things that really take a minimal setup and then you can put them on autopilot, okay? And I want to make this distinction between passive income and running your own business, because sometimes the lines get blurred a little bit, okay? So for me, passive income is something that yeah, I mean, you're always going to have to, if you want to make money, folks, you got to do something for it. You always got to have time to set it up, right? But then these true passive income investments or true passive income sources, then they're going to be pretty much on autopilot, okay? And the two best examples really are self-publishing, so writing a book and publishing it on Amazon, right? I've got 12 books out there actually I think about 13 books now on Amazon, and they make me a few $1,000s every month, and I do nothing to promote them. I probably should do more to promote them, because you do have to kind of try to keep them ranked a little bit, but really, nothing, absolutely nothing to promote them. I spend maybe about $10, $15 each book a month on ads on Amazon. Other than that, though, they're completely passive, right? The online course is the same thing. Basically, I set them up. It takes a couple of months to set up an online course, and then I've got them out there on Teachable, right? So I mean, these do take time to set up, but then they're almost completely passive afterwards on autopilot, just making you a few $100s to a couple of grand even every month. You've got things like maybe an affiliate blog or blogging, which not necessarily completely passive, because you got that blurring line between passive income and business. Some business ideas are going to take regular work, but do have a little bit more of a passive component, right? One of the best, the most popular videos on the channel, I actually did about 3 years ago, right? And it still gets a few hundred views every single day, still makes money on those ads every single day. So that part of it is passive, but the larger business of having a YouTube channel and running it is the farthest thing from passive, right? You have to be continuously creating content, interacting with people, things like that. So it's very much more of a business rather than that passive income part. Right, and so I've got a couple of videos on the channel about making your own book, your own online course. And understand, folks, everybody asks me, well, I don't know what I would write about. and everybody has a book in them. Seriously, honestly, scan Amazon Kindle, on your mobile for 5 minutes, and you will see books for everything. Okay, if you enjoy underwater horseback riding, there is a book for that. Somebody has written a book for that, and they're making money off of that book. More importantly, right? So find something you enjoy doing. Find something you would like to learn about doing. Right? This is so powerful about this is because whether it's blogging or a YouTube channel or writing that book, people want to go on that journey of learning with you. Okay, so not only can you write a book about learning about something, about learning underwater horseback riding, right? Everything that went into you learning it and understanding it. Then later you write books on how to, that kind of thing. So from that area of expertise. So first it's maybe a journey, kind of more of a self-development book, right? You and your journey on this, learning this. And then it's more of an instructional and how-to book after that, right? So there's definitely stuff in there. Anything that you do for a living, your work or anything like that, folks, anything you do for more than 5 hours a week, every week, you are an expert in it. I mean, understand that. To anybody coming into that topic that isn't spending that time every single week doing it professionally, doing it as part of their job, they are so far behind you that something that they need to know and that they want to know. So, don't underestimate yourself as far as what you can teach in books, what you can teach on online courses. There are so many blogs and so many books out there that not necessarily even teaching somebody something, but sharing that journey, sharing that personal journey and that experience. And people want that. After a year and a half locked into our homes, people want those experiences. They're buying those experiences through those books, through those courses, and whatever you want to produce. So again, don't underestimate yourself and think you don't have anything to write about or anything you can write about. You can definitely write a book. Again, a couple videos on the channel going to show you exactly how to get that idea and format that and write it and make writing really easy for anybody, as well as the online courses. Another thing a lot of people talk to me or tell me is they don't know the first thing about technology, about the internet or about starting a blog or starting a YouTube channel. And I gotta tell you, this is it's if I can do it, anybody can do it. Okay, I would like to consider myself average intelligence, at least maybe even a little bit higher, but I can't lie to myself. I am average intelligence, folks. If I can do this, anybody can. It just takes a little bit more work, a little bit dedication. But when you start in on this kind of thing, it's really you really start enjoying it, right? Learning that whole idea of starting a channel, of making a channel successful, making a blog successful, things like that. And it's not going to take any more than, it'll take maybe 2 weeks really to figure out what you need to understand, what you need to know about starting a blog and how blogs make money and things like that. And then you're into it, right? Again, started the blogs in 2013, really didn't do anything until 2015 or 2014. And then it was so after I got started and finally got the blogs up, then it was about 6 months and I actually started making money, right? You actually start seeing that money come in and you've got that path, that light at the end of the tunnel, as they say, for that financial freedom, right? So don't neglect any of these just because you think you're not an internet person or, you're not a writer, right? Again, it's not the writing people are looking for. It's the experience and the personal journey and feeling connected with someone else after a year of being locked down, that kind of thing, right? When you're starting starting your own business, and again, the lines between these are extremely blurry. Whether you're starting an affiliate blog, which might take a little less work on a daily basis, rather than maybe a blog where you're posting every day, or a YouTube channel where you're trying to get ideas for videos and you're doing videos a few videos a week, then you start to get a little bit more time commitment. But again, what I want you to do, if you're thinking about starting a blog or starting a YouTube channel or starting any of these little business ideas, right, that we talk about in some of those videos linked in the description there, start it as a hobby. Start it with 5 or 10 hours a week and just enjoy learning about it. Enjoy, creating those goals for how fast you're going to grow that business, right? Don't stress out over whether it's going to be a success in 5 months or 6 months or not. Okay, just create something, get it out there, get it started. That's the biggest thing is people get this analysis paralysis where they want everything to be perfect before they even start. Just get it started, folks. I mean, any kind of business, if you're not looking back on what you did a year before, right? So if you get from a year from now and you don't look back on your blog or your YouTube channel and say, man, this sucked. I didn't know what I was doing, but now look at how much more I've learned and how much more I know. Then you're not progressing fast enough. You're not doing what you need to progress, right? Everybody does that. I look at after 4 years of doing YouTube videos, I look at my videos from just last year and I'm like, wow, these are horrible, right? But it's only because, I know so much more now about the process and about delivery and that kind of thing that I've grown, right? So don't feel like everything has to be perfect and you have to love what you're putting out there to just get started. Just get started. In a year from now, you are going to be so much happier because you've got that path, you've got that goal, to making that there. So I want to open this up to questions. Feel free, any questions about my business, about growing a business, an online business, passive income, whatever, as well as stocks. We'll answer questions on stocks and everything. Again, just great seeing everybody here. I love these Fridays, or these. It feels like a Friday, doesn't it? These Sunday live streams. Just informal talks with you, all you out there in the nation. So what do we got here? First of all, I mean, it's great seeing everybody from so far. We got Germany, Scotland out here, Switzerland. Man, so it is an international bow tie nation, folks, and I love it. So what else? Motley Fool subscription. Okay, Flipper asks, is the Motley Fool subscription worth it? Great question. Since I do have that 5 stocks report free. So if you want to see the 5 stocks in my portfolio, you click through and you sign up for the email list. It's totally free though. But a lot of people ask me, okay, is the full subscription worth it, right? And honestly, I use the Stock Advisor subscription on Motley Fool for a lot of good ideas. They do have a great track record as far as stock picks and things like that. Basically, it's just kind of it's kind of an advisory service where they're talking about individual stocks, kind of a lot of what we do on the channel. No obligation to do it. They're going to send you a lot of emails asking you if you want to pay the subscription and all that kind of thing, but no obligation. You click through the link and get my five top stocks report for free. But yes, I do subscribe to the Stock Advisor thing as well. What else do we have? Looking for, if you got a question, make sure you use a question mark so I can see that it is a question, and get to that. Love the chat, the talking back and forth in the community. It's not all about me. I want you to be able to talk to your other citizens of the Bowtie Nation there and talk back and forth there. Side thing, very reputable. Compare the channels and audiobooks. Silver Mamba talking about audiobooks there, and yeah, a regular self-published book, an audiobook. There are so many options out there that you can make money on, right? And it's not that necessarily that any one of these things make a ton of money usually, especially starting out, but you add them all together and they are legitimate sources of income. Let me show you, let me open up something here and I'll show you exactly what I'm talking about with this. So here is my revenue tracking, right? This is, I track my revenue. Obviously, as a business owner, you got to track your revenue and expenses. My expenses are actually extremely low because I pretty much do everything myself. I've got a graphics artist that does some graphics for Pinterest and Instagram every week. I've got an assistant that helps post things to the blog, but for the most part, I mean, I'm creating all the content and everything myself. And you can see here, really, this is 2015. $60 that first month. Okay, $60. And it started with the books, right? And that's a great place to start because, if you're starting blogs or starting, a YouTube channel, you're already creating that content. You're already, creating the ideas and the information for people. Why not just transform it into a book, right? You could take a lot of the stuff that you're talking about, create a book for Amazon to publish on Amazon, and you're making money, right? And you can see for that, this was like 6 months in, and even for that first year, the books were almost exclusively the 90% of the income of the revenue, right? So within that first year, I made $5,400, so just over $5,000 in the books that I was publishing. I started to make a little bit more money on affiliate sales, but that was about $6,600 right there. So it does take time to get started, but you ramp up fast. This was 6 months in, so within a year of starting, within a year of starting, I was up to about $2,000 a month, right? We got $2,000 here, and you see how fast it grows. These are the monthly revenue for the year. So 2015, I was up $800 a month. 2016, $2,900 a month, so about 3 times almost. 2017, I doubled it again the next year to up to $5,500 a month. So within 3 years, really, of starting these, I was up to about $5,500 a month, which is really solid given this was probably right at this point. This was less than a full-time job. I was still doing a lot of freelancing, working with a lot of Wall Street analysts, providing reports for them and that kind of thing. So then, and then it goes up, ramps up pretty quickly. 7,000 the next year, 12,000 in 2019, 24,000 a month in last year, and then this year so far it has averaged $56,000 a month, right? Actually up to $64,000, a little over $64,000 in June in this last month. Which and you can see here that for a lot of these. It's not a huge amount. Books, about $1,500, about $2,000, $3,000 in some months. The courses, a few $1,000s. YouTube ads is about $20,000. Affiliates and sponsored posts. But the idea is, putting a lot of these things together and really, making a whole business out of them. Okay, 200 ruble super chat. I appreciate that. Thank you there. So he wants to know. You want to know? I'd like to hear general news of stocks. Want to know if you consider making a Discord channel to be able to talk to you during the day. So great questions about the Discord channel. I'm really kind of stretched thin as far as what I can do. I'm creating, the 3 videos a week, the live stream on Sunday. I do the 5 times a week, the daily market update, the Bowtie Daily. So that's a few hours every day. I do the blogs, the 3 blogs, as well as, the social media and all that. So really at this point, I'm really trying to find, somebody to help me manage the blogs, some other kind of ways to scale up with that staffing and stuff to be able to do some of these other things, like a Discord channel, maybe even a podcast, things like that. Some ways to connect a little bit more with all you out there in the nation. But right now, really kind of stretched thin, working, 50, 60 hours a week just on that stuff. General market news on stocks. And folks, it's tough because, as an analyst, I'm always kind of assessing the market, trying to find, where the stuff is to buy and what to sell and kind of worrying about that market, the general market trend or the movement. And so you get into that idea of where you should be selling because this market is undeniably expensive, folks. All you got to do, you can take all the analysis in the world, but really all you got to do is look at a stock chart over the last 2 years. Okay, look at any stock chart over the last 2 years, especially in some of the growth stocks, especially in look at the ARK Invest chart over the last couple of years, and we can actually do this. I want to do this just to show you what I'm talking about. So I mean, you can do this on just about any fund, any stock out there. But we'll use the ARK-K, the ARK Innovation ETF, because it's a great example here of what's happened. And you look here, and we'll do the chart, and we'll come out to a 5-year chart, right? And it's growth stocks, so it did well. It did well from 2016 here, doing well, 2018, 2019, even into early 2020, right before the pandemic and stuff. And then look at this. I mean, and this is almost every stock chart you look at. Well, you could look at it if it was the right size. Let me readjust the size here. Okay. Oops. Okay, there you go. Okay, so again, did well, decent annualized returns here. And then look at this last year. And again, this is almost every single chart, every stock you look at, any growth stock, any tech stocks, even a lot of the traditional sector stocks. Something just happened here over this last year. And this is not normal, folks. I mean, you go back, that's the max chart. Let's even look at the S&P 500. Let's go back and just look at the index. So this is the largest 500 companies in the United States, or based in the U.S. And we can let's look at a 5-year chart here. So this isn't like growth stocks. This isn't like tech stocks where you would expect them to just really just jump higher, right? These are large multi $100 billion companies that don't have that kind of growth. Okay, they just do basic market returns. And even here, I mean, you can see, did really well 2017, 2018, 2019. But then just in this last year, I mean, that something happened there to really drive the market higher, right? And you got to, when you're looking at the stock market like this and trying to get that generalized feel for, if we're in a bubble, if there's a stock market crash and it's coming up or something like that, and whether you should rebalance. We talked Friday about how you shouldn't necessarily just sell every time someone says stock market crash, right? Because more money has been lost by selling in fear and then panicking and all of that than really has been lost in the crashes themselves. But you do need to rebalance sometimes, out of some of the riskier sectors, and that's driven by that general, stock idea of the stock market. And so you ask yourself, if what happened here in this last year that just caused stocks to double and triple, is that sustainable? Is that going to keep on going, right? And the obvious answer is it can't. The Federal Reserve pumped out about $4 trillion here in the last year. The government, not just the U.S. government, but all governments of the world, pumped out trillions of dollars into the economies. Interest rates are about zero, right? And that just can't happen every single year. Okay, so really the stock market is on a sugar rush from all of this money and these low interest rates. And typically what you see is that when the Fed starts talking about higher interest rates, when they start pulling back on some of that sugar, right, then the stock market suffers, because that's all that was supporting stocks in that near term or in that period. Right. So right now, I am back to probably about 20% in cash. I've got another maybe 10 or 15% in safer investments, bonds, rebalanced into real estate, things like that. And I mean, sure, I do not think the stock market is going to have more than maybe a 10% correction at the most this year, because economic growth is just too fast. Economic growth of 7% plus in the U.S. and in a lot of the developed world, and that you just don't get a crash with that, right? We're about to enter second quarter earnings seasons. Second quarter earnings are expected to be up 62%, okay, which is just historic. You don't get 62% earnings growth any year, right? So that is amazing growth, and you just don't see stocks crash when that happens. Now, later on in the year, towards the last quarter, second half of the year, as we're entering, even into early next year, stocks are going to come off of this sugar rush, right? So even if, by having that money in cash, by having that money in bonds and safer investments and things that are going to keep my, keep my balance relatively stable, even if I miss out on a little bit of those returns, then when that drop comes, then I'll have that cash ready to be deployed, right? I'm only missing out on, maybe a few percent return, but I can protect myself from, a 10 or 15 or 20% drop. Right, so that's really where I'm coming from with the market. Right, I am a risk averse investor. Right, I am just fine with missing out on 3% of annualized returns. Right, maybe I only get 6% instead of 9%. Maybe I only get 9% instead of 12% that the market reaches. But if I can avoid really that big drop off, if I can avoid the 20% sell off when stocks do crash, then then I'm much more happier, and it's a lot less stress. So that's really what I'm looking at in the market. Okay, is we've obviously got some kind of a sugar rush going on in the markets, right? It's something that cannot happen forever. The Fed is expected to start talking about its scaling back its bond purchases at the Jackson Hole, the Jackson Hole Symposium in August, right? So basically, background here, folks, is the Fed's still pumping money out in the system. Okay, had 850,000 jobs created last month. Everybody expects the U.S. economy to do about 7% annualized, and the rest of the world along with it. But the Fed is still pumping money out, right? The federal government, the U.S. government is still talking about infrastructure and spending more money and that kind of thing, right? So there is still a lot of money being pushed out into the system. Interest rates are zero, basically, which means there's really no better option than stocks as far as returns. The market is now watching for, okay, when is the Fed going to start talking about, start pulling back on some of the stimulus? Okay, the Fed is still buying $120 billion in bonds every single month. They're buying mortgage-backed bonds, they're buying treasuries. Really, and when they buy those, they pay cash for it, right? So they push cash out into the economy to try to juice the economy, right? So what we're talking about here is, the Fed is very soon, probably in August, maybe even before that, going to start talking about, okay, how much fewer bonds do we buy each month? We're buying $120 billion a month right now. Maybe we start by buying only $80 billion. Okay, and so that's the signal to the market that the Fed is pulling back on that stimulus. Okay. Something else that I'm watching is kind of interesting, kind of an interesting idea is we've had so much money poured into the market over the last year from retail investors, from regular investors with those stimulus checks, basically, or collecting unemployment and just sitting at home investing in stocks, right? So what I'm thinking, what happens is when those people start going back to work, what happens when there's other things they can do other than just sit around and invest in stocks and trade stocks all day? Does that pull some of that enthusiasm, some of that interest out of stocks? And I think that's another thing that really the market isn't looking at. It's not expecting it, and I think that happens. That starts to happen here, through the summer, into the fall and the winter, and then obviously definitely next year. So some things I'm looking at as far as the general market. Sign up for the Bowtie Daily. It's really a much better resource where I can collect my thoughts every day and put into words, into text there, what I'm looking at as far as the news, the sector trends, the industry trends, and things like that. What else? Another great question there. Do I still consider materials, industrials, and financials a safe play, or is everything in a sugar rush? Is an excellent question, because obviously when you're looking at the whole market here, you got to think, okay, are there some places that I can invest that are going to be relatively safer? And I think that is still very much the idea of little relative safety in those materials, industrials, and financials. They're obviously still going to get hit. You look at any recession or any stock market crash in the past, and even the safety sectors, even the safest sectors like utilities, real estate, consumer staples, those still got hit in a recession. So I think don't think that you're going to completely avoid any kind of sell-off, any kind of a crash, just because you're in safer stocks. If you're in stocks, they're going to be risky, right? But you can miss out on some of those losses, right? You can limit your losses and really reduce your stress, and really that's the key, right? Reducing your stress so you don't freak out and panic sell everything when the crash does come, or when even a correction comes, so you can kind of keep your head and buy back into the market at those lower prices, right? So if you're talking about safety, obviously, the safest is always probably going to be those utilities, the consumer staples companies. I think consumer staples have really sold off here over the last few months, just because of those higher costs, those fears about higher costs. Things like Clorox, things like P&G, things like that have already sold off. So I think, the risk in those stocks is even a little bit less, right? Because the stocks have already paid for that inflation premium that we might see in other stocks later on in the year. So utilities, consumer staples, obviously. I still do like materials, industrials, and financials, though, very much so. Obviously, with that kind of economic growth, you're still going to get materials and industrials to do really well. As interest rates go, as inflation increases, then you're going to get the resources that a lot of those produce. Those prices are going to go up, so they're still going to do well. I really like financials here, though, especially because one of the biggest hangovers on the market right now are those interest rates, right? The inflation picture, how it might push interest rates up, right? We've talked about on the channel before, interest rates are so low that any stock with future cash flow, those fast growing momentum stocks, those tech stocks that have all their earnings out into the future as future cash, those are valued much higher right now because interest rates are zero, basically, right? So as those interest rates go up, discounted cash flow formula says that those stocks are going to be worth less, right? As you discount them by that higher interest rate. But that works just the opposite for financials, right? For financials, higher interest rates are good, right? Because for banks, banks make more money because they're able to charge higher interest on those long-term loans. Insurance companies, other financials, right? They're making more money on the money that they're investing, right? At those higher interest rates. So financials, I think, is a great safety play against what's one of the biggest drags on the market right now, which could be interest rates, right? Interest rates are still very, very low, even on the long end of the curve, have come down over the past month even. But I think financials are really, really primed to do that, especially the banks, which, as we've seen over the last couple of weeks, what we've been waiting for, they're starting to raise their dividends, they're starting to raise their share buyback programs. So I think it's a really great place to look right now for stocks. Any views on ICLN? Coco wants to know about ICLN. That is the clean energy ETF, and I really like clean energy right now. It's been hit over the past few months. It really came down after that February-March sell-off, but obviously this is where the real trend is going. Now, understand, I do think clean energy, a lot of these stocks, obviously they're high growth stocks. They're very expensive stocks right now, so they are going to get hit, if we see any kind of a sell-off, anything like that. So, I think you got to go into them with a little bit of caution. I always suggest, especially some of these more expensive tech stocks, growth stocks, that you go in with maybe 50% of what you were going to invest, hold the other 50% for over 3 months, 6 months to invest, just to see if maybe you get a little bit better prices. But the ICLN Clean Index or a Clean Energy Fund, a great way to invest in clean energy because you get the whole sector, you get the whole theme, right? That whole theme, which is obviously going to do very well under this administration, maybe the next, but even on the side, even on the political side that hasn't typically favored those alternative fuels, alternative energy, things like that. That side is starting to come around to the theme and the idea. So I think clean energy, alternative fuels have a lot of momentum behind them that's really going to carry them through over the next decade or so. Okay, Barrett wants to know how small of an investment would I recommend to invest at any one time. Not quite sure what you're asking there. You can invest whatever you want, whatever you can, right? I'd say everyone needs to be investing at least $50 a month, right? And it's surprising what that kind of consistency every single month can grow to, right? If you're investing $50 a month, it can grow to 100. I did the math a little while ago. It's $187,000 over like 20 years, right? Which is just amazing, because anybody can afford $50 a month. It's basically one less night out a month or out a week, something like that, or even less. Okay, so $50 a month, bare minimum. Beyond that, whatever you think you can afford, or whatever you need to invest to really get there. A lot of people asking about what is QYLD. Now, QYLD is a fund, right? And I'll go ahead and put it up on the screen here so you can see what it is. I like the fund. It's not something that's going to make you rich or anything, but it is a really interesting fund as far as what it does here. So the QYLD is the Globalx Nasdaq 100 covered call ETF, right? And so what this does, it invests in stocks in the Nasdaq 100, right? So tech stocks, large tech companies, in fact, very stable tech companies. But then it immediately sells covered calls against those, right? So it owns the stocks. Then it sells an option against those to another investor to buy those shares from them, right? So it's a little less risky than just owning those stocks, right? Because they collect that premium, and they've got kind of a hedge against a weakness in that. And what you'll see here is that the yield. So 12% yield right now is what this is saying. It might be a little bit lower, but dividend yield of 12% is really pretty amazing. And how this works is now this is really popular right now because it does do well when when the market's kind of sideways or slightly up, right? Because it still makes money on those covered calls, and it can just keep on selling those covered calls against it, right? Now, again, with something like this, it's if the market falls, if the Nasdaq 100 starts falling, this stock is going to fall as well, right? There are going to be some losses. It won't be quite as much as the index itself, as those Nasdaq 100 shares, because it's doing that hedging. It's using those call options to hedge the risk a little bit, to lower the risk. So when the market falls, this isn't going to lose quite as much, but it will still lose some money. But you'll still have that fairly good dividend yield to hold you up. So that's a lot of the reason why it's so popular is because it has that dividend yield. It's not the end all be all fund. I do like it. And I think it's a great addition to a portfolio because it's got that yield. It's got that exposure to stocks as well. What else? Inflation is not that's a great question. Okay, so I just scrolled through and missed it, but somebody asked, do you think inflation is transitory? And of course, this is the $1 million question as far as stocks right now and the stock market. Okay, because really the Federal Reserve has two mandates. It has two rules as to how much money it can pump into the system, how it manages those rates, and all that. And those two rules are one, employment, full employment, right? It wants to see the unemployment rate down to 3-4%. And it wants to get people working, right? The other one, though, is kind of the counter to that. It wants to see low inflation, modest inflation. The Fed's current target is 2%, right? And it's said that, inflation has been really low over the last decade, so it wouldn't mind if inflation is a little bit higher for a little while, maybe up to even 3%. It can kind of work in that range, right? That 1.5 to 3% range, and not be worried, right? And how it does this is it lowers interest rates, right? If you lower interest rates, then you get businesses to reinvest, right? Because there's no sense sitting on that money if you're not making any interest on it, any interest rate on it. So if they lower rates, businesses invest, savers take their money out of savings and they invest it, they spend it, things like that, right? So they lower interest rate, juice the economy, unemployment rate comes down. But if they do it too much, if they make money too cheap and they push too much money out in the system, obviously you get inflation, right? You get prices that just jump higher, right? So it has to kind of balance that. And, so looking at that inflation rate, that's what the market is looking at to really determine, okay, is the Fed going to get spooked, and are they going to take this money out of the system that it's pushed into the economy over the last year, right? Right now, we've seen inflation just take off. Okay, consumer inflation about 5% so far. That's the highest since the 90s, early 90s, back into the 80s even. Producer prices have jumped just as well, the most in decades. Okay, and right now the Federal Reserve is saying it's just transitory. It's just something that's happening this year because inflation was lower last year because we've got all these stimulus programs out, but inflation is not going to be a problem over the next few years, right? And for the most part, investors, the market is agreeing with them. Okay, it's saying, yeah, okay, we believe the Fed, they're smart economists, whatnot, and we're not going to sell off stocks, right? Because we're not thinking that the Fed isn't going to get scared about inflation. They're not going to pull back on all this money in the system. Okay, now I'm kind of thinking they're wrong about it. I mean, the Fed is obviously much smarter than I am. There's smart economists in there, but I think they're underestimating inflation. I really do. I do not see how they increased the money supply, so the supply of money into the economy last year by 26%, right? I mean, which is just unprecedented. You'd never see that much money pushed into the system. Okay, usually it's more like 6% money growth, right? 26% last year. You don't get 7% economic growth without more inflation. Okay, we're already seeing where a lot of employers, they're having to boost their wages, their wages offered just to get people to come back to work. And that's going to be more than just a little transitory inflation. Okay, so I think that's one of the biggest overhangs on the market right now, and probably one of the biggest surprises, one of the biggest bets, I guess. I don't like to say bets because it implies you're gambling, but I think if you're with the market, with the stock market, with investing, you got to come out on one side or the other, right? The market always has its narrative, its story of how stocks are going to develop, how earnings are going to develop. You can either invest with that or you can invest against it. Okay, generally the market's pretty smart about things and has the picture down, has that narrative down. But if you can find where you think the market is wrong and invest with that, that's where your biggest returns are, right? Because that's where the biggest risks are. That's where the biggest surprises are in the market. And that's really what's going to drive, the prices out 6 months and a year from now. And from my view, I think that's really where the biggest surprise is going to be, that this inflation idea is more than transitory, is that, we do get higher inflation than the Fed is expecting right now. And they are forced to bring back a little bit more of that stimulus and pull back on that. So if you're looking at that kind of perspective, that kind of outlook, then yeah, you want to be in inflation protected investments, inflation protected stocks. Okay, stocks like the materials, like energy, like financials, like industrials, things that benefit with a little bit higher inflation and that are going to do well. You've also got you got commodities. So the commodities themselves, oil, natural gas, gasoline, the metals, copper. You've got gold, which is a good inflation hedge. You've even got a little bit cryptocurrency. I won't say Bitcoin or other cryptos are really a great inflation hedge because the prices move around so much, you really can't draw that relationship. But there is some kind of an inflation hedge in there. I think obviously some of these other factors for cryptocurrencies are much stronger. So, you invest because of that, not necessarily just because of inflation, but there is some inflation protection there. So, from my perspective, from my viewpoint, I think the market is wrong on inflation. It's obviously not going to be like 80s or 70s style inflation where it's like 10% a year. But, even at this point, after a decade of having inflation of only, maybe 2% or less, 1% inflation, then you get 4% inflation, and that's double it, right? So that's doubled inflation, and I think we get very close to 3-4% next year, which would be quite a surprise for the market. Patrick wants to know about thoughts on investing in emerging markets, India or China, ETF that are safer. Excellent question. I used to actually be a big proponent of emerging market investing. Actually wrote a newsletter for, and I can't even remember the site, the website. I used to do a weekly emerging markets newsletter for them. Loved talking about emerging market stocks. But you know what, folks? After investing in emerging markets for so long, after living in Colombia for more than a decade total now, I've come to realize that a lot of emerging markets are never going to emerge, okay? And I don't say that to be disrespectful of the people there or the markets or anything like that, but it's just for a lot of these markets, it's just a different culture as far as economic growth and making money and personal success and things like that really keep them from that economic growth. Okay, I'll just speak to Colombia here, which has done well in the past, but it is not a country that prizes personal achievement in financial matters, economic growth, and things like that. There are just too many hurdles as far as corruption, crime, productivity rates, and worker productivity, things like that, that are always going to keep it from doing that. So, I mean, I do like a lot of the Asian countries like China, Korea, a lot of those other countries, because they have a little bit more market focused culture of success and growth and things like that. Obviously, with China, it's really tough right now because they are really, really coming down hard on those companies. They told, Didi got just like a week after its IPO, Didi, that the China Uber, right, got removed from the App Store because the government told all the app stores to delete it from there. So obviously that's going to be down big on Tuesday when it starts trading again. So I think it's risky. I think you can probably get 90% of what you need out of large U.S. companies that invest or that work globally, that operate globally, as far as your emerging markets investing or and even Euro funds, funds that invest in companies across Europe. I think those are good alternatives as well. As far as the emerging markets, I think you go with that fund. You go with maybe one or two funds that give you exposure to many countries, to much of that growth, and be happy with that instead of trying to pick those individual companies. So obviously good funds for emerging markets are the EEM. I think that's the Msci emerging markets fund right there. So the Ishares Msci fund, that alone is going to give you access to or exposure to dozens of countries and thousands of stocks in emerging markets, and you're going to do well. Okay, and not. I mean, if you look at these, if you look at the charts on some of these, though, I mean, it really goes against what people think of as emerging market investing, right? Because obviously with emerging markets investing, you're supposed to be getting higher return, right? It's higher risk. It's an emerging market. Maybe, laws are a little less well established, that kind of thing. So you're supposed to be making an extra return for that. And, if you look at the comparison with just, maybe the S&P 500, we'll do that one. It just hasn't happened. It belies that reason for emerging market stocks. So we're here at the 5 years, and the S&P 500 has beaten 111% return to 67% return for emerging markets. We can go out even further. Let's go out a decade. Okay, so 2011 to here. So over the past decade, I mean, it's a tough argument to make, right, for investing in emerging markets. The theory is that, yeah, they're faster economic growth because they're catching up with the rest of the world. So in theory, you should be making money, right? But it just hasn't come out like that, right? Because I think in a lot of these countries, there is just structural and cultural reasons that productivity just isn't there. The corruption is there, crime is too high, things like that really keep them from emerging. Okay, you look right here over the last 10 years. The S&P 500, largest companies based in the U.S. but doing, obviously international business, have grown by 221%, right? While that EEM, that emerging markets fund, has only done 13% over that period. So it is really no contest, and it's really hard to make that argument that you should be investing in emerging markets. Again, I think maybe you hold one of those broader funds that give you exposure to a large region in the emerging markets. Maybe Asia does really well, but other than that, I think there's just too many hurdles to these countries and to these stocks to making a good return. Okay, what else do we have? What do you think of gold and silver stocks? Excellent question. Frank wants to know about gold and silver stocks. All you out there in the nation, that I love the stocks, the miners, better than the actual commodity itself. Okay, just because they can leverage that price, that commodity price, into higher profits, right? And you're always going to be making that dividend, even if the commodity price stays flat, right? So a great example of this. Let's we can even look at this. Let's look at the GDX, which is the gold miners, the VanEck Vectors Gold Miners ETF, right? and let's compare that to the actual price of gold, right? And we'll use the GLD, which is the gold trust, which just owns gold bullion in a reserve vault, and so you get the price appreciation on that. And then I don't know. There we go. Okay. So we've got the GDX, which is the gold miners ETF, and let's compare it with chart conversations. I don't know why this isn't giving me the. Okay, for some reason it's not letting me compare the GDX with the gold price. Let's see if we can get the. There it is. Okay, let's compare the GDX with the GLD. Okay. So here we've got the gold price in red, the GDX in blue. Okay, so here we've got, let's look at the last 5 years. Okay, so the last 5 years, GLD has actually outperformed a little bit, 30% versus 18% for the GDX. In the last 2 years, it's been reversed. The GDX, so those gold miners have outperformed 35% versus 25% in the price of gold. Now, what this doesn't show you is those dividends, right? So even when the gold price is outperforming a little bit, then I think you're going to get a better return out of those miners, right? Because they're able to take those that gold price and leverage it and provide those dividends. But really what you're thinking, what you need to understand here is that anytime that gold prices are increasing, the miners are going to do better, right? Because again, they're able to leverage that gold price into higher earnings. Anytime gold falls, anytime the price of gold falls, then the gold, an investment in gold or the gold shares here is going to do better, right? Because it's you're losing money on the gold, on the price of gold, but it's not leveraged. Okay, so that leverage works both ways. Companies that can leverage the price of gold to higher earnings, they're also going to lose more money when the price of gold comes down. Now, I do like I said, I do like the gold miners at this point. With gold at around $1,800 an ounce, it is well above the price that these companies are paying to extract the gold. Most gold miners have an all-in sustaining cost, so operational costs plus all those other costs, an AISC of around $1,000. Per ounce, right? Maybe even as high as $1,200 per ounce for some of these. So they're obviously making very good profits and able to return those to shareholders for that. So again, if you're looking at higher inflation, I would be in these gold miners rather than gold itself, unless you're investing in the gold futures, right? And that's something totally different. Gold futures, obviously, you get so much more leverage leverage on your money that you can make a lot of money with gold futures. Okay, what else? Like the thoughts on global 15. Oh, okay. So open for 45. It's a interesting question. Thoughts on the global 15% tax rate? I don't think this is an issue right now. I mean, if you look at the history of global cooperation, as far as all this thing, countries actually coming to some kind of an agreement is pretty much zero. Okay, I mean, to think that all the countries can agree on, a certain tax rate and they all pass it within their legislatures and all that, I don't think it's going to happen. I think what you much more need to be worried about or looking at is tax rates in specific countries, right? So obviously, I think tax rates in the U.S. are going higher. Tax rates in a lot of other countries are going to be going higher just to pay for a lot of the stimulus that we've seen, a lot of these programs that we've seen. So tax rates are going to be going higher. I wouldn't put too much faith on any kind of a global tax rate though. What else? You still holding Alibaba, and thoughts on Msci for inflation hedge? Okay, so I don't know Msci, but I will say I did actually sell off my Alibaba about a couple of weeks ago. And a lot of this is just it's just hard watching a stock with so much potential, being held under the Chinese government that really is. I won't say is trying to kill the company, but they're really not making it any easier. Okay, I still think there's a lot of value in Alibaba. I'm just not sitting around waiting for it. Okay. I think there's just too much risk there in a lot of these Chinese company stocks. Too much risk that the Chinese the government comes in and really destroys years worth of returns on those stocks. I mean, we could see Alibaba go up easily. I think the fair value is much higher. I think it could easily go up 20 or 30%. But then you always got that headline risk that the government is coming in, it's doing something, and it destroys all of those returns over years and years, in one fell swoop. So, again, I'm a little bit more risk averse, so I don't like those risks. So I pull back on those, more than most investors would. I think Alibaba still can be a great company. If you just look at the valuations compared to Amazon, it is still very attractively priced. But you have to be able to take those risks. Okay. Okay, so John was, as a new investor in a stable financial position, should I wait to make a lump sum investment given the concerns for a correction and keep investing to a minimum, or should I approach it? Excellent question, and it's one that, again, I'm kind of torn because, again, I mean, just from my own experience, just from seeing other investors, more money is lost by trying to time the market than actually even getting caught in a lot of these sell-offs and these crashes, things like that. And there's no loss for people saying the market's in a bubble, market's expensive, the stock's going to crash, things like that. So I think you don't have to wait. What I do think you can do to really avoid the worst of the worst when a crash does come is just smart investing, smart portfolios. That really aren't so common anymore, right? Over the last couple of years, growth stocks, tech stocks have just zoomed so much higher that everybody thinks, okay, well, I just have to buy tech stocks. I have 100% of my money in tech stocks, and I'm going to be rich within a couple of years. Those are the people that are going to get hurt when that sell-off comes. If you just take a couple of ideas from just traditional smart investing, you're going to be able to invest your money now, enjoy that growth, but not get quite as not get destroyed from what happens to the market. So, and within that, I think you start off with asset classes, okay, and that's stocks. That's the big category: stocks, bonds, real estate, even cryptocurrency. Okay, and you have some money in all of them. Okay, bonds are shit right now. Bonds aren't producing a lot of return, but they're great for safety. They're great for that cash preservation to take advantage of those lower prices if they do come along, right? So it's going to make you more money than what your cash sitting in your savings would anyway. So you have some bonds, maybe short-term bonds, so they don't get hit by interest rates quite as much when those rise. You have some real estate through real estate stocks, real estate funds, things like that. You have your stocks, but you have not just tech stocks, but you have your other stuff, your consumer discretionary, your financials, materials, industrials, right? You really spread out your portfolio. That way you can at least invest now. You can enjoy the rest of the market rise. And when it does eventually fall, you're not going to get destroyed with that. Okay. Beyond that, I think much more than just a one-time investment. You really got to think about investing as a lifelong thing. Okay, investing is kind of like exercise, right? Like working out. Okay, you can't just go to the gym 1 week, build as many muscles as you can, and you're gonna have that forever. Okay, it's got to be part of your life. Okay, and if you really look at it as something I just got to get done with, I got to get it over with, then it's always going to be like that job. It's always going to be something that you don't want to do, and something like that. But if you just make it part of your life, make it part of a regular routine, then it becomes a hobby. It becomes a personal challenge, things like that. Investing is the exact same way, okay? You need to think about investing as, okay, you know what? Investing is just something I do every month. I put in, $500, $1,000, whatever I can manage, whatever doesn't detract from my own personal enjoyment this month. I don't want you investing 90% of your money, okay? Live your life, have fun with your money, that kind of thing. Invest a few $100s or maybe even a few thousand a month if you can, right? It's that idea of just regular investing month after month, year after year. that is going to make you rich, folks. It's not making this 10 or 20% return every year. That doesn't make you rich. Getting rich is about, just doing it continuously every single month. So, yes, you can invest now, invest that lump sum, but do it in a way that you can invest every single month as well, from your income, or maybe just have a little bit set aside in cash, maybe 10 or 15% of your money set aside in cash so you can invest every single month. Frank wants to know what I'm drinking, and this is a 86 gold intense gold beer. Not quite certain why it has to be gold, why people always want gold in their beer and their liquor and all kinds of things like that, but it's an imported Dutch beer I got from in a Father's Day basket I got for Father's Day, so that's always a good thing. 6.5% alcohol by volume, so a little bit stronger, and probably why the live stream is running on a little bit longer than I expected. But I just love talking to you all out there in the nation so much. Okay, I gotta address this. Let's see a lot of talk about AMC and all that in the chat. And Nolan says, ready to decide, what is your take on AMC? And so let's talk about it. We do every week, but I understand it is persuasive, okay, to look at that chart for AMC, for GameStop, for those, and to think, man, I can get rich real fast, not have to worry. I gotta have my financial independence in a month instead of 10 months, or instead of 3 years, 5 years. But you got to understand what you're doing here, folks. If you're into gambling, then sure, go ahead. But there is no reason why AMC should be a $26 billion company. You pull this back and you look at this chart, and this 5-year chart. Back in 2016, 2017, 18. This was like a golden era for movie theaters, right? Everybody was going to the movies. Economy was strong. Everything was good. And the most this ever made, it was a $33 stock. So 33, about half. It was about a $15 billion company in the best of times. Okay, now we're looking at a $26 billion company. And if you want to actually look at the company and look at the investment, then there is just no way to rationalize, to justify this stock price. Okay, you look at a company that is competing with streaming right now. Okay, a lot of these content providers like Disney, like Comcast, HBO, Universal. They're putting out all their content on streaming. They're saying that they're gonna give movies those exclusive distribution rights for the first few months eventually, but they're not. They want to make more money. They make more money on their streaming packages than they do selling the rights to AMC for a few months. Okay, so they are never going to go back to exclusive rights just for the theaters. Okay, so you look at a company that is competing for its life in this streaming versus theaters thing. You look at a company that has put on billions of dollars in debt over the last year, that has increased its share count by millions of shares. Okay, that's something a lot of people aren't looking at right now, is that all these companies, AMC, GameStop, a lot of these companies have taken advantage of these very high stock prices to issue millions and millions of more stock shares, right? So when earnings do come back, if they do come back, then you're sharing those earnings with millions more investors. Okay, and so there is just no way to reason, no way to rationalize or analyze this stock, at a point where it is at right now. And what I think is going to happen is eventually, you can see here. So for AMC on a year to date, it did pretty much nothing for most of the year. It got a little bit of bump in January when GameStop was really going up, but really it's had its day here in June 2nd. $62 from $12, right? So almost about fivefold. So people made like 400-500% on that stock within a couple of weeks. But then look, June 2nd to so basically over the last month, it's done nothing, right? It has done nothing over the last month. So what happens when a stock that is based purely on that idea of getting rich, what happens when it stops making people rich? Okay, people sell it. People leave, and so it loses that one reason to invest in it. Okay, all those other reasons point to a lower price. It loses that one reason, and for this, we're talking about a lot of these other stocks, right? These stocks that have blown up, like AMC, like GameStop, like Clover Health, a lot of these that just have no other reason other than maybe some more people will come along and buy them. Now, a lot of people are going to, in the chat or wherever, they're going to say, no, you're stupid, man. Just everybody hold on. Everybody hold on. If everybody invests in these stocks, we can all be rich. You know what, folks? You got to think about that. Okay, you got to think about that, what other people's motivations are when people are flashing diamond hands and stuff like that. You don't make any money until you sell a stock. Okay, you make zero. You have not made a dime on a stock until you sell it and you book those profits. Okay, honestly. So what these people are saying is they want you to buy it, you to hold it until they can, because nobody's making money until they sell, right? So who's going to be the first to sell? It's all these people saying diamond hands, hold on for dear life, right? But what they really mean is, if everybody just buys it, holds on, pushes the share price higher, then I can sell eventually and make a profit, and then I really don't give a damn what happens to the stock. Okay, that's the reality of this whole thing, right? It's not everybody just hold on and keep buying, because eventually somebody has to sell. And I guarantee you give those people with the diamond hands the option of, okay, now we have to take profits. Who's going to be the sell first? They're like, right here, those diamond hands. I'm selling now because I want to finally say that I've actually made money instead of just holding the stock. Okay, so, invest for yourself. Don't invest because somebody else pressures you into holding it forever and really supporting the stock price. Okay, that's not what this is about. I'm sorry. What else we have? A question on OTC stocks, DPLS, great products. Are there a possible way given valuation OTC in general with minimal info? David has a question there. Thank you for the super chat. I appreciate that. Question on OTC stocks. Is there a way to value these with minimal info? All of these, even the over-the-counter stocks. Okay, so if you don't know, all the exchanges, the Nasdaq, the NYSE, the Amex, they've got requirements for filing, for accounting and all that to be issued to trade on those exchanges, right? Now, a lot of companies, either they don't want to or they can't afford some of these, rules, some of these regulations, right? So they trade on the over-the-counter market, right? And, so it is riskier. There's less information here. A lot of times, maybe these financial statements aren't audited, things like that. Now, you can always go to the investor relations page and look at their presentation information. You can always look for third-party analysis on these stocks. Now, you always have to look at it with a grain of salt and with a skeptical eye, right? You have to look at, okay, so where is the stock done? What's the financials done in the past? What is management expecting in the future? And is that realistic? But you have to be really skeptical of these. And one of the things, and this is really the reason why, I recommend kind of a venture capital investing strategy for a lot of these penny stocks, not just OTC stocks, but just penny stocks in general. And this comes from my days as a venture capital analyst, where even the big dogs out there, even the venture capitalists, with billions to invest, with hundreds of millions to invest, that have these teams of researchers, these teams of analysts that can actually go visit the company. Even those, they'll see 40-50% of their investments flop. Okay, they'll see 4 or 5 out of 10 of those companies that they invest in will return less than the money they invested in them. Okay, that's just the nature of these very small, risky companies. Okay, so what they do is they build a portfolio, of 10, 15, even 20 or more of these companies, of these stocks and these companies, and they let it play out. They let it play out for 3 to 5 years, that way. You're going to get those 4 or 5 that are going to totally flop, but you still get those 5 or 6 that do 10 or 20 or even 30 times your money. Okay, Peter Thiel made 4,000% on his early investment in Facebook, right? 4,000%. That is that's a 40x return, right? 40 times his money. right? And that's what you're really looking for in these penny stocks. But you got to give them time to develop. Okay, you've got to be willing to let those 4 or 5 just completely flop and waste your money, and give those other 5 or 6 time to do that. So what you do, I mean, you do your research, you hold those 10, at least 10 stocks, I'd say even 15 to 20 penny stocks in your portfolio, and just let them run. Just let them develop, let them prove to you what they can do over 3 to 5 years, and you're going to get that return that's closer to 25 or 30% annualized in that, because you're going to have enough of those winners that are really going to do well. Okay, what else do we have here? Oh, okay. So open for 45, talking about and this is crazy. This is one of those things that I've been watching lately. These ransomware attacks that, there is an opportunity there, but the cybersecurity companies just aren't rising on those. It doesn't seem like the cybersecurity companies, the stocks are doing a really good job of leveraging that, that fear of ransomware, or fighting the ransomware in the market to really send their stock prices higher. They're doing well, and I think you need exposure to these cybersecurity stocks. Definitely, it has surprised me how little they're benefiting from this. Okay, I mean, these ransomwares, affecting thousands and thousands of companies every month, and yet you look at this index fund, this ETF MG Prime Cybersecurity ETF, ticker HACK, HACK. Obviously gives you very, very broad exposure into the entire theme of that cybersecurity space. And it's done well over the past year. So 45 up to 60, 15, that's about 30% increase over the last year, which is really just about market performance. A little bit better than market perform. But even this year, it really hasn't done that well as you would expect, with all the fear and all the momentum in this theme. Maybe that's an opportunity to invest here at a lower price. Like I said, I own shares of Hack. I do think you need to own shares of these companies. I own shares of Hack, as well as Zscaler, ticker ZS, which is a smaller cybersecurity company that I think is really one of the best in the industry. But yeah, that is a big theme right now, is that cybersecurity, the ransomware attacks that are going on, and how much it's affecting our lives. Okay, it's going on an hour and 20 minutes. I want to get you back to your barbecues, and I want to get back to my barbecue with my family. So I appreciate everybody for being here. Again, sign up for the daily bow tie with that link in the chat or in the video description below, totally free, and you'll get those daily market updates on the market. I love doing these every week, and just kind of informal chats and talking back and forth with you. So I appreciate it. Be sure to check out the videos we've got coming up this week. We've got some really great videos this week. Stocks with 50% plus upside. So I looked at all the analyst targets out there for stocks and found the ones with 50% or higher potential to those analyst average targets. So going to be a great video for you. Check that out. I think tomorrow we've got a little bit more of an informational video, but check that out as well. Till then, I will see you in the next video.